Hi, this is Harish, here with
Rootvij,
Mahesh,
and Raghav.
And we welcome you to the first episode of our podcast, The Dogs of Dalal Street.
We call ourselves the Dogs because we look out for your investment efforts and we are loyal to our listeners.
And contrary to the name, which is just a nod to the Wall Street of our home country, India, we will mostly be discussing American markets on this show. We will be your best friends when it comes to investing during a pandemic, and we're here to help you learn the basics of finance, capital markets, and applied economics.
But before we get started on the topic of today's episode, industry impacts from the COVID-19 recession, let's quickly introduce ourselves.
Alright, so hey guys, I'm Rootvij, and I'm an incoming junior at the School of Science and Engineering in Dallas, Texas. I enjoy learning about finance, econ, psychology, and theoretical physics. I love basketball and working out in my spare time. I've come together here with my friends today to make a finance and capital markets podcast.
Hey, I'm Mahesh, also an incoming junior at the School of Science and Engineering, and good friends with both Rootvij and Harish. I've just recently delved into the land of finance and economics, and before about 4 months ago, I was primarily focused on computer science as my career to pursue. But I still am, however, I found a sort of balance between the two fields in financial tech, algorithmic trading, and quantitative analysis. So I hope you guys can gain valuable insight from my discussions with the rest of the group as I delve into the more technology-heavy side of things.
My name is Harish. I'm an incoming junior at the School of Science and Engineering, and I am good friends with both Rootvij and Mahesh. I have an interest in finance, economics, and politics, which is why I joined this podcast. In my free time, I enjoy swimming, working out, and reading. I've decided to join this podcast so I can help more people understand the economics in America.
Hello, my name is Raghav, and I'm an incoming freshman at Walnut Hills High School. I'm interested in computer science. I play soccer in my free time, and I like working out. I recently took advantage of this free time and started learning about economics and stock markets because I really believe that you need to have good financial literacy and a good understanding of the stock market if you want to make it out into the real world.
Alright, so I'll set a little bit of a background here. As we know, the COVID crash led to massive drops in liquidity and investor confidence. We were having multiple circuit breaker days in a row due to people fearing an imminent collapse of the entire capital market system. And now when we see this on a microeconomic scale, we early on especially saw issues in specific supply chains, which ultimately caused scarcity for certain goods, which meant that the production of goods would be inhibited. On top of that, the labor force feared catching a potentially life-threatening virus, which led to lowered worker productivity and efficiency, and multiple governments across the world had to force shutdowns. In essence, the flow of money on this scale was clogged. As soon as productivity stops advancing, none of the other money cycles can move. Without money, there can be no transactions, and without transactions, there can be no money. The system implodes on itself due to no aggregate demand. So, there's the layout of the situation. This irregularity in cash flows creates a lot of volatility, and it was volatility that we got. The SIBO volatility index was high, and a few fortuitous short sellers were able to make money as retailers, airlines, and numerous other companies in industries filed for bankruptcy. Many see this as the market's natural selection process, because these companies were too weak anyway, and they were only hanging on by a thread. Other companies rebounded stronger than before and are now trading at all-time highs. As the weak died out, the strong took their place. What do you guys have to say about the market's natural selection, volatility, and the initial recession?
I will talk more about this in my segment, but again, a lot of these companies that fell off had lower market caps, which basically caused them to collapse. And it's not good to invest in a lower market cap company. So a lot of these companies were just about nearing bankruptcy anyway.
During this coronavirus crash, we saw a lot of people staying at home, mainly focused on online e-commerce. So this really put a heavy blow on companies such as AMC, which is in person, JCPenney in person. And these companies, of course, have gone bankrupt, but we might see more companies like this go bankrupt because people are afraid to go outside. We might see an entire shift in the American economy where we see more companies going online rather than having brick and mortar stores open.
Yeah, and additionally, I'll actually go into more of the online transformation side of things. But just to bring up some other companies who have been really heavy hit by the pandemic, Hertz is one of them. And when we go to talk about the volatility currently going on, I mean, as you guys have seen, Hearst is just insane with being a completely bankrupt company and then rebounding 100% after the pandemic. It just goes to show how little valuation is starting to play in the American economy and how much volatility we're experiencing right now.
Yeah. So and Hertz is a very good situation about where retail investors have increased their volume of trading. And it's literally only because of retail investors that stocks like Hertz were, supposed to they're supposed to go to zero essentially. I mean, they were not supposed to have any real valuation, because just imagine that a company, they're not able to pay off any of their debt. Why would you keep buying them, boosting that asset to a point where, even the CEO came out and said that, like, I think it's overvalued. Why are you buying it? But And I think it's because of this buy the dip mentality that sort of came through. But I don't think that you're a frugal investor if you put all of your chips into the most risky assets that you can find. You're probably just uneducated about bankruptcy and debt. So now what is bankruptcy, right? This is a really important topic to cover, because some people hear bankruptcy and they think either it's a good investing opportunity, or they hear the company is finished. And really the reality is somewhere in between both of those thought processes. So a bankruptcy is a legal process that an individual or a corporation who is a debtor owes money to another entity. It could be a bank, it could be individual, it could be a loan shark. So they are the creditor, and they can use this to seek relief from the debt that they owe to their creditors if they're unable to pay back the debt. So in the United States, they're defined by Title 11 of the United States Code, with 9 different chapters that govern different processes of different bankruptcies, and it depends on the circumstances and the entity declaring the bankruptcy. So for publicly traded companies, Chapter 11 and Chapter 7 are the most common. Chapter 11 is reorganization, and Chapter 7 is liquidation, where you sell your entire enterprise value. So don't be the type of person to buy just because you expect a recovery either, because if the company reforms, they may get rid of their previous public offering and come out with an entirely new IPO as a part of the restructuring phase. So I think this happened to General Motors in 2008. So again, like, you'd want to be careful, because you'll probably get paid a lot less for the stock in reimbursement from what you bought it for. So I would advise any new investors to not just buy any stock that's trading at a discount for like any illegitimate reasons. So and another example for this would be like Chesapeake Oil and Gas, right? Initially there was like some really big spikes in pumping the stocks, but as of now they're like flatlined or delisted. So yeah, I mean, if you're an amateur, please focus on bankruptcy, understand what it is before you start jumping to any conclusions and dropping all of your money in it. So just a disclaimer: anyone who's considering investing in beat up equities, just be aware of that. So each episode we're going to discuss the theme of investing 101, and today's has to do with debt and equity financing. A metric to understand the debt of a company would be to use WACC, or weighted average cost of capital. So I'm just going to read this excerpt that explains WACC on Investopedia. So to help understand WACC, try to think of a company as a pool of money. Money enters the pool with 2 separate sources, debt and equity. Proceeds earned through business operations are not considered a third source, because after a company pays off debt, the company retains any leftover money that is not returned to shareholders in the form of dividends on behalf of those shareholders. So investors often use WACC as an indicator of whether or not an investment is worth pursuing. Put simply, WACC is the minimum acceptable rate of return at which a company yields returns to its investors. To determine an investor's personal returns on an investment in a company, simply subtract the WACC, weighted average cost of capital, from the company's returns percentage. So, what does all of this mean? As long as you read that last sentence, you don't really need to understand the rest of it. Returns equals company's return percentage minus WACC, aka higher the WACC, the more debt the company is in, and the less investment worthy it is, especially in a recession time. So, start integrating WACC into your investments to understand how risky they really are from now on. Please do note that more debt is not always a bad thing. It can mean that the company is more confident in their growth and has more leverage for the growth. But it most certainly is during a period of economic uncertainty, especially for industries that will have to burn tons and tons of cash to stay afloat. So let's get to debt now. Raghav especially, right? He's going to be talking about tourism. So Raghav, what do you think about debt, and how important was that when it comes to researching companies in your industry?
So a lot of tourism companies were facing massive losses, right? And they needed money to stay afloat, right? So they took out loans, big loans. And that led to a lot of debt, which they have to cover. But uh, some of these small companies might go bankrupt, but a lot of these big corporations are confident that they will recover from this crisis just because of their sheer size. And I always say this, but if you're going to invest, take out a larger portfolio for investing in more safe stocks like bigger corporations. So yeah.
All right, next person.
Yeah, debt is also really important when someone wants to invest. Now, typically that wasn't an issue before the one app that like a lot of people use now, Robinhood. See, Robinhood has given a lot of amateur investors the opportunity to invest in companies without actually fully being aware of the company's financials.
So, Rutwich, in terms of debt, let me be talking about banks, but these banks have lent a lot of money, especially retail banks and consumer lending. They've lent a lot of money to all these people. And as people are going unemployed, that debt can't be paid back. So now, this might be a real serious situation for banks as they need to find a way to collect on the money that they've lent out so that they don't go bankrupt.
And when it comes to debt in the tech industry, I mean, there are certain key players like the software as a service industry that are taking out debt and using leverage to their advantage to circumvent the hardships during these times. And we can go into a whole nother topic of using leverage and things like 3 times leveraged ETNs. But in an essence, some of these companies, when they take out leverage, they're able to turn around the economic situation by taking out debt in the short term, but being able to pay that back in the long term and using that as leverage in the short term to secure their immediate debts.
All right, so I'll move on to an individual industry. So here's my first introduction, I guess, right? The tried and tested industries of manufacturing and aerospace and defense. So the examples of these legacy companies would be Boeing, Raytheon, Ford, GE, Honeywell, Northrop, Lockheed Martin, Huntington Ingalls. These are the companies that the government absolutely cannot let sink. And when it comes to defense companies, it's all about the tax policy. As far as I can tell, no politician would come into power, this late in 2020 that'll reduce defense spending or defense contracts to a point where these companies will go bankrupt. So this will be at most a temporary spending or defense cut, but the only issue that I would see here is if like foreign contracts volume decreases. And as of now, nobody's focused on defense, but in my opinion, conflicts are more likely to occur after we're dormant. So there's social unrest going on right now, and I don't think there's like any chance that defense contracts will be absolutely destroyed. Sometimes I feel like we'll spend just because the defense countries need to stay afloat. So this is one of the issues in the pandemic right now, though, is that in terms of how COVID has impacted these industries, their earnings have gone down significantly, and they're no longer the focus of our tax dollars. So not only that, but these defense contractors are large-scale manufacturers as well, and they create tons of jobs in blue-collar type industries. So many plants have closed down due to supply chains being disturbed, and recently they have started reopening, but at the same time, they're not at full capacity again. The sales for some of their goods have gone up, but again, it's not at a point where we can say that they're back to what they were pre-coronavirus. The catalyst for this industry will be a reopening and a recovery in allocatable tax revenue from the United States government. So Boeing and GE especially are in a bit of a special situation that they're not only defense-based companies, but they're large manufacturers as well. Watch out for product announcements, as they can be signs of financial strength, like Boeing's 737 MAX. And when it comes to manufacturing, like auto that we have, look at Ford's upcoming electric car lineup, since that happens to be a big booster of market confidence. Also, watch for the demands of existing products. Used car sales are up because less people are less willing to get shiny new cars, which can be considered sort of luxury goods. But eventually, that's going to go change back to normal. So, I don't think manufacturing ever dies, right? Like, what do you guys think about manufacturing? It's not like we're ever going to stop making stuff.
Yeah, I mean, you're absolutely correct. Like, we need manufacturing to make products. So, yeah, that's.
I mean, yeah, obviously, it's these core industries that are going to, just persist through whatever happens, right? I mean, I guess the worst case scenario is if they don't even have the income to pay back their workers or whoever's allowing their supply chain to keep manufacturing. But I mean, that's a very rare circumstance that I don't think we're going to see anytime soon. So yeah, manufacturing companies are going to,
I mean,
succeed.
even in like recessions, people still have a large demand for goods. So these companies still have incentive to be manufacturing the same products, but also new products that people might want to buy due to the different scenarios.
Right.
Yeah, like ventilators, right? Ford got a big order for ventilators along with General Motors. So yeah, I think there's a turnaround of the industry and how people really view it. So that might be, permanent, that might be temporary. But I think one of the bigger impacts is how the outputs of these companies has changed.
Yeah, due to the demand, all these companies are doing things that you'd never think they do, like Tesla making ventilators, which you would have never thought of, but when we now have a demand for ventilators, they're doing it because they can, but no one would have thought that they could.
I mean, Tesla is making shorts now too, so I think they can make anything at this point, and analysts will be happy. So manufacturing will never die, right? And especially when fiscal policy is currently in the state that it is, where the average blue collar worker is sometimes making more from unemployment than they are from their actual job. Just look at the price to earnings ratio of these industries, and you can tell that they're undervalued. A lot of these defense companies, they're trading at price to earnings ratios of sub 15. But at the same time, Tesla is trading at some sort of infinite price to earnings ratio. Zoom is trading at I don't even know. I think it's like in the 10,000s at this point. So that may be for good reason in some instances. I mean, there's always some rationality behind the market, but some of these companies are obviously taking on tons of debt, and they're very predictable and easy to understand. So there must be a reason why analysts are lacking in confidence in terms of these companies, but they're only going to be in this situation temporarily. And a boon for these companies will be low interest rates until 2022. A lot of these financial models rely on the Fed's interest rate, and the positive updraft that they can provide for legacy companies is undeniable. If you believe in mean reversion, you will believe in these manufacturers. Just think about the discounted cash flow model. It's all based on the spending that the company has regularly, right? And it's based on the cash flows every year and how they're changing based on interest rate, based on tax rates. And if fiscal policy is so, how do I put it, corporate friendly at this point, and it's going to be until the Fed is projecting until 2022, then the faster we recover, these companies may go back to above pre-coronavirus levels, because as long as that policy is there, they're going to be earning way more. So I'd say a lot of the recovery in these, the recovery in these industries, they rest in the hands of the virus. So that's why you'll see these bounce back, especially when there's good vaccine news out there. So what do you guys think of the fiscal policy and how it helps these companies specifically? And what's the future outlook for them?
I mean, a lot of companies are in very deep holes, but if we provide them with enough fiscal policy, then they'll be able to make it out of that hole. But some companies just won't be able to survive even with these new fiscal policies in place.
Yeah, later I talk about banks, I talk about lending. And I think this is a time when the government should put a limit on how much money it's giving and lending to these companies. Because even though we might go into debt right now, in a time of necessity, it's going to ultimately pay off later when the American economy comes out even stronger after coronavirus is vaccinated against.
Right. And one other thing I wanted to add is that so when interest rates go lower, a lot of people start to assume that inflation will rise with the Fed pumping out so much money and lending out so much money to companies in need. People think that, well, it's intuitive to think that inflation rates would go up. But just to dismiss that, I want to say that inflation only goes up if spending goes up, right? And we've seen recently that spending is trending higher, but it's still low from pre-corona levels. So as of right now, inflation is not going to go up. And actually in the recent Fed monetary report, inflation actually went down. So only when companies fully open up is inflation actually going to go up. And then we might see some negative impact from fiscal monetary policy, but I don't think that's much of a concern at this point.
Yeah, monetary policy is very interesting, but I think we'll hold off on that until the next episode,
Right.
which is because it's such a big topic. But here's my bearish perspective on these manufacturing companies. They were already trading at a discount before coronavirus happened. It's not like Ford wasn't at a discount compared to what its enterprise value truly was. It's pretty much at the same value as it was before if you adjust for the recession. So it's not like they're all, they're not, it's not like they're necessarily at a discount, but here's what I mean by that. I think that retail investors will see how low these companies are from their previous prices, and again instantly make that same fallacy and assume that, okay, well, they deserve to be pumped up, which they do to some degree. But when I start seeing that they get pumped up to, above pre-COVID levels, then that's something to be somewhat, worried about. Like, are we in a bubble right now? So Ford was already trading at like a price to earnings ratio of 9 before the pandemic. It didn't get too much worse because their earnings got worse, right? So if you're concerned about valuation, it might not be, as drastic of a difference as you think it is right now for these. But at the same time, if they're able to come out of this stronger and pick up some of the momentum from the Fed, then that could be, sort of a bullish view for them. Just because Boeing 737 MAX, they're testing it again with the FAA passing on it, and hopefully these big airliners they're ready to take on some new orders and stuff. But as of now, because fuel is so cheap, I don't think they'll want a more efficient aircraft, which is essentially what the 737 MAX was for, right? Same thing with the Airbus A380neo. So I'd say don't get too confident just because there's possible bright outlook. This sort of goes both ways. So in terms of industry impact, I'd say just I'd give it a neutral rating in my opinion. What do you guys think? Like, the valuation, is it really really that good, or was it just adjusted for COVID?
I think.
I mean, as you said, the valuation was already at a discount coming into COVID, so it didn't have much of an impact. But Harish, you wanted to say something?
I mean, so when we see these companies being pumped or anything, it's not really something we should be worried about, really. It is a natural reaction that the investors have a bullish view on the American economy. Of course, no one wants the economy to crash. So we can assume that even after COVID, the current pump won't really decrease or anything. It'll probably be constant as we reach pre-COVID levels. Some companies that have been pumped too high, they may stabilize to pre-coronavirus levels, but most companies will be increasing in price.
So again, pumping is bad, but sometimes debt is necessary in times of crisis, which I think is a very important point I have to make here.
Yeah, debt is all good and well, but I do believe that at the end of the day, when these companies start recovering, it's going to be because of mostly investor confidence and not because necessarily the valuation was so great because it was good in the first place. But yeah, let's move on from manufacturing and go into real estate. As you can tell, if you've been watching the markets at all, commercial and office real estate has been battered by shutdowns, and it may not recover for years because a lot of companies like Twitter, they're sort of introducing these permanent work from home policies, and you cannot find a better possible point to buy into these because this initial crash, I think there's just maybe an overreaction to some degree. So try to find real estate investment trusts that aren't heavily leveraged in poor quality mortgage-backed securities. Because again, 2008, these crashed pretty badly, but they were able to recover just as well. And they provide great dividends. So, but that's going to be an issue, especially right now, right? Because you owe so much to your shareholders. It's kind of hard to stay afloat with the structure that you're at right now. So we can discuss more about the mortgage-backed securities and all that in a later episode. But so some of these REITs have so much cash it's sort of burning a hole in their pocket. And they're 100% willing to use it to buy out retailers. So that could bring out an entirely new, source of income. So there are these versatile REITs that I think have really, really good chance of success, like Simon Property Group. So as long as the population keeps growing, the need for land will, right? Land is one of those everlasting commodities. So it's not like these, office rights they're not going to adapt to the situation. They're probably one of the most adaptable because you can use land for whatever you want. You can use it for data centers. You can use it for 5G towers. Speaking of those rates have been doing great. So I'd say look out for when we start reopening again, because that's going to be the biggest sort of move for these rights, because some of them are down 70%, 80% from their pre-COVID prices. And yeah, I mean, even tech-based real estate investment trusts, they'll be a good investment in the future as well. And I think they're still sort of undervalued to some degree. So yeah. And on top of that, demand for housing has gone up to above pre-coronavirus levels because young people are seeking larger and larger spaces for themselves, and they want lower contagion risk so that they can be outside with their kids, or they can play, they can go on picnics, whatever. So and the rates of these new mortgages has increased. So Fed bailout money to businesses will be undoubtedly spent on paying rent, but we can never be sure that all the rent is going to be paid, which is again sort of the negative perspective here. So real estate investment trusts may not see their highs in probably a long time. I mean, if what the Fed is projecting is true, that our GDP is going to shrink by 5%, the recovery is not going to happen until 2021, 2022, then yeah, they might not recover just as quickly, but in terms of their industry impact, they'll be able to bounce back. Land is an everlasting commodity. I think land is one of the most stable investments, and most people realize this. I mean, land and gold are, for the traditional investor who don't want to, delve into equities that might be corrupt, that might not, that might be artificially inflated. So, several of these REITs have cut their dividend payments, which is a clear indicator, though, that the debt is taking a toll on even the largest of these trusts. But watch out for the ones that do last, because they will eat their competitors' market share. And yeah, I mean, they have a clear path in front of them if they do survive this. So again, this is one of those situations where cash is king. Look out for the weighted average cost of capital again. Look at the structuring of these rates. Look at their clients, and look at where they're located, especially. So, especially like Austin, Texas. Like, that's a really hot area for real estate right now. What do you guys think about real estate investment trusts, and what's your sort of perspective on the debt that's sort of killing these companies almost to the point where they're going to like 80% below their book value?
So, in my opinion, the buy the dip mentality applies like the most to these types of industries that have been hit the most, right? You could take it both ways. One, that they've been as low as probably they're ever going to go. Their valuation is very undervalued, so you could take that as okay, buy, but at the same time, rent isn't being paid. Housing demand is up, but in the immediate short term, we're not going to see any kind of increase in the price of these stocks. Maybe after, like you said, after reopening, demand's going to skyrocket. Competitors are going to eat each other up, and stuff like that. But
yeah. Or there's a landlord bailout, which I think some governments may be considering. As of now, a lot of people who are renting, they have money to blow on this, but at the same time, some of them don't. Like $1,200, it's not always going to be great. It's, I think, $600 a week for unemployment, which is not bad. I think that should be enough to pay off a good amount of rent, which is again why I think like these might be undervalued, right? They're probably getting fed by the Fed. So yep. I'd say still watch for landlord bailout, because a lot of them are running up to the administrations. They're asking like, hey, look, we need money to float ourselves up, or else all of this land is going to be like, it's going to be unused. It's not going to be utilized at all. So yeah, what do we want to do with this land? Think about how innovative these rates are, how young the management is. If they're able to somehow convert the whole retailer space into a data center, then I'd say buy up. If they're able to convert the land into sort of, I don't know, new living space that millennials love to live in, because there's lower contagion risk there. Let's say it's all spaced out really well. So a lot of these housing projects and stuff, they should do better, right? So rates, they're based around a bunch of different industries, which is why, again, it's all about the individual equities at this point. I can't give you one industry. So but the industrial impact overall is obviously very negative. I mean, continue this on, guys.
I mean,
I think okay. So rights are probably the ultimate buy and hold now, but of course it also depends on what the rights are focused in. For example, if we look at rights that are heavily in
apartments in urban areas, subprime lending, these probably mostly go to lower income families, lower income neighborhoods. And these communities have been hit the hardest by Corona because low income jobs are mostly going to be in person. And they're probably essential workers right now. And they've been laid off, like restaurant employees, supermarket employees. So these rights might take much longer to recover than rights that are focused in land for commercial uses. Land given to like headquarters for Amazon, for new supermarkets, and also they're gonna take longer to recover than rights that are focused in suburban lending, because these communities tend to have people that earn higher. They're probably going to be focused in things that haven't been hit too hard, such as technology, such as law, such as medicine. And so it really matters what right you're going to be investing in, and you know what that right specializes in.
So I think a lot of rights, like a lot of these real estate companies are losing money because they're not innovative on what to do with the land, right? Because if you have land that's empty right now because of the COVID crisis, you should convert it into something that would earn you money as an asset, because it's not generating any money right now, and it's creating massive amounts of debt. So yeah.
Yeah, I'd say ultimately it comes down to which industry the rate is focused in, because each of those have their own pluses and minuses. And the debt also comes into play when you try to... It's really about which project you go into and how that project is going to turn out in the future. Because certain projects, like Harish said, the ones that mainly affect low-income communities, we might not see we might not see a positive outlook in the near future, but I don't know, maybe office-based, or after reopening office buildings, buildings that are more spacious and that allow for more spread out housing, those kind of spaces will flourish. So yeah, it comes down to what kind of project, what kind of industry.
Mm-hmm. Yeah, and I was earlier talking about how some of these rights are innovative in terms of like buying out the retailers that they're lending to, right? So, for example, look at the enterprise value for Simon Property Group. They own some of the largest shopping malls in America. Right now, it's $43 billion. Before COVID, it was an astounding $70 billion. So, so in reality, I think it's probably somewhere in between those two numbers. And for example, JCPenney has an enterprise value of $4 billion, right? So is it possible for them to buy out JCPenney and bring in new management? Yeah, it's possible. But, you know, will it make the property group overinflated with too much management, too much bureaucracy? That's also possible. But at the same time, if they're able to integrate JCPenney's business model along with theirs, then, you know, that might be a good move for them, right? And these recessions bring in the best time for imminent opportunities. So again, make sure your picks are right. You can put all of your eggs into one basket and watch that basket, as Andrew Carnegie said. You only need to research one, but if that one strikes gold and you're confident on it, you know, that's going to be a good company. Then that's going to be an opportunity for your retirement fund to, you know, double. So yeah, that's just my 2 cents on rights. Do your own research about them, and again, they're one of those industries that are super isolated and they're kind of hard to understand the structuring. So if you're amateur, I guess, you know, be more careful about where you invest. Maybe invest in an exchange traded fund that includes rights in them. But as of now, my view on these is like they're probably trading at a really big discount, right? And just yeah, pick and choose carefully. And okay, so I'll move on to the next commodity, oil and gas. Right? It's just like land will always be in demand until we find cheap and renewable energy. Many oil giants specialize not only in the acquiring of the resource itself, but petrochemical research. Exxon, for example, is researching how to make fuel with algae. So even they realize that at one point oil may be phased out, or either artificially by governments or by another, you know, competitor. So and this isn't a bad thing for Exxon. It's good that they're staying ahead of the curve. They have a lot of cash to burn. But for other energy giants like Chesapeake, they're a natural gas driller. The sudden drop in oil and natural gas production was a curse. And the same story will hold true, that the companies with more cash and less debt will survive. And they'll probably come back stronger than ever before. So as of now, the OPEC has decided to slash oil production massively. So when oil demand does come back as tourism and travel reopen, expect major gains for oil giants like Exxon and Chevron, as their monopolized structure is built to outlast recessionary periods. Watch carefully how much these companies are willing to pay out to shareholders through dividends as well. The industry itself may not have the recovery hopeful investors want, as market demand for energy companies that are not renewable is historically at its lowest point. And there's a lot more positive investor sentiment in like hydrogen fuel cell companies or electric car companies, and even solar panel companies, and they've seen massive gains. And it's clear that investors may be pricing in the idea that eventually renewables will take over traditional energy. But just don't be too sure that it's this soon. Any value investor would take Exxon over Tesla any day. What do you guys think about oil and gas and the crunch of, crude oil that's happening right now?
I think it's really situational. Right now, it's just because of coronavirus, everyone's staying home. We don't have that much demand for gas, especially things like airplanes, cars. These things, no one's using them a lot anymore. But of course, it's not that this is going to be a permanent change. It's not like people are permanently switching to electric cars and there won't be a use for oil anymore. Of course, once we start reopening, people will go back to their gas cars. We might see a switch to renewables later, but I don't think that's a reason that you want to stay away from oil and gas right now.
Yeah, so what Harish said, there's not a lot of demand for gas right now, as there like numerous energy industries like airplanes, cars have slowed down, right? So I think we need renewable energy, but I don't think we're gonna get it this fast because again, there's a lot of oil that's here. People always gonna say it's gonna run out, but it's gonna be here for a while. And I think we have to find renewable energy sources eventually, but I don't see it coming within the next at least 5 years, maybe.
Yeah, I was just going to say, like, with the collapse of tourism comes the collapse or the decrease in sales of oil. And I mean, you have these hyped up companies like Tesla, Nikola, other ones that are trying to explore other alternative fuel sources like, hydrogen, electric. But I mean, there's a lot of research that needs to be done, and oil isn't going to disappear anytime soon. So yeah, reopening is going to heavily affect these types of companies in a positive light.
Yeah, so and another thing to remember, that oil companies don't just make stuff for vehicles and things that move. They, oil is used to make plastic, right? Not like plastic is going anywhere. We're making more and more N95 masks, aren't we? So
right.
Yeah, I mean, I think there's probably a bit of too much of a urgency for investors to sell these out, but I think eventually, again, these are all going to come back. I mean, traditional industries, they're not going to go anywhere. And there's no reason for, stocks like Nikola, who haven't even made a vehicle yet, to, have a bigger market cap than some of these like legacy manufacturers that have cash, that have valuable assets, that have good management. I mean, if you've seen Nikola, you know what I'm talking about. It's really hard to believe. So
right.
I'm gonna move on to the next topic, or I'm gonna hand it off to Mahesh real soon. But first, I just want to conclude. More and more hedge fund managers are advising retail investors to stop running up the liquidity pump for industries running purely on the hype, and to use old school valuation instead of trading risky securities and getting burned. I'm somewhere in the middle on this opinion. I think some of these companies legitimately do have bright futures that are, going up by big amounts for, seemingly no reason. And yet, but I also think that many of these industrials are getting lowballed compared to their book value. So what do you guys think about buying into companies that are truly undervalued?
I think you have to know what company is undervalued and what company isn't, because if you make the wrong assumption, it could be a disastrous mistake for you, as you said, putting your eggs in one basket, something like that. Because then you can lose money really really fast, or you can gain money really really fast too. You just gotta read up. You just gotta research more. Yeah.
Yeah,
I think
the basic stock principle is buy low, sell high. And when you see an undervalued company, you're going to be really tempted to immediately buy it. But you should take a minute and think about when other investors are going to see that it's undervalued. Because you might see it's undervalued, but for the market to realize that, that might take quite a while. So you want to think about that before you go all in on an industry that no one really knows about.
Mm-hmm. Yeah. And when it comes to valuation, I see it as two ways, right? There are companies that are undervalued and that are going to stay undervalued just because the market doesn't see any potential in them. And then there are other companies which are undervalued and may suddenly spike to be overvalued in the near future because it ultimately comes down to the opinion of the majority. That's who's driving the market. So if the majority of people think that a company has value, then it's going to keep going up. But at the same time, you can't expect companies like, I don't know, Tesla, Zoom, ones that are incredibly overvalued to keep climbing. You gotta kind of find that balance.
Yeah, and I'll end this with a quote by John Maynard Keynes. I'm not sure if this was him precisely, so don't quote me on this. But it goes something like, "The market can remain irrational a lot longer than you can remain solvent." So that's holding true, especially today. So we'll move on to Mahesh.
All right, so I'm gonna discuss a little bit about the tech industry, right? So the tech industry is probably one of the least affected industries from the COVID-19 pandemic. Specifically, software as a service companies, which I'll just abbreviate to be SaaS, PaaS, which is products as a service, and e-commerce companies, right? So these three kind of industries have faced almost the least impact, or actually have received a positive impact from the COVID-19 pandemic. And that's mainly because the closure of a lot of these brick and mortar shops are leading, because of negative customer sentiment, these online companies, like these SaaS companies, who are able to capitalize on this decrease in spending, and also companies who are able to move their infrastructure and business models online were able to capitalize on this decrease in purchasing, right? And so moreover, companies that already centralized around software and the internet flourished, obviously. I just want to read a little quote that says, peak traffic in impacted regions increased on average approximately 10%. And in Italy, which you guys may know as one of the most affected countries early in the pandemic, the internet traffic in Italy rose by 30%. So you can already see how SaaS companies have drastically increased in valuation as their services became more widely adopted, namely Zoom, Cloudflare, Nutanix, among others. But SaaS companies have that benefit of securing a constant stream of revenue from their clients through subscription-based services, so basically making them virtually unaffected by the pandemic. And we discussed this earlier, but certain manufacturing companies have been negatively affected by the pandemic because their supply chains have been hit. And it's in the same case, it's not all sunshine and rainbows for the tech industry. There are hardware manufacturers like AMD and Nvidia who have been doing relatively well in stock price, but Nvidia specifically projected a $100 million revenue hit for the first fiscal quarter in 2021, and that's mainly just because of a decrease in their output and their supply chains, which mainly reside in China. And despite the continual growth of these companies, the electronics and appliances market suffered about a 30% decline in retail sales from January to May. And not only the sales have been affected, but actually the shipment times and delivery times, which indirectly affect the valuation of these companies. So the least affected industry in tech is probably the TV industry, which was hit around a negative 4.5% in terms of shipment time, and the worst impact was on smartwatches, being around negative 16%. So with longer shipment times, you have lower customer sentiment and then lower sales, and it's kind of just this snowball. But software companies, as I just discussed, have been doing incredible. E-commerce companies, incredible. And then I just want to say a little thing about food and product delivery services. So you've heard of things like Postmates. There are other ones like Zomato and other companies, but these types of companies were already on the rise because convenient food ordering was a hot and in-demand industry. But there are minor setbacks when maintaining health precautions during pickup and delivery. But these companies will continue to climb as more people stay in quarantine and need a way to get their meals. And I see, as we begin to reopen, this industry is very fragmented. You see a lot of players in the industry of online food delivery like Uber, Uber Eats, and then Postmates, and there's countless others, but all of them, or some of them, are actually specialized in specific countries. So not a lot of them have made a monopoly on this industry. And I see in the near future for some key player to emerge as the primary player in the online food delivery and on-demand food delivery service industry.
Yeah, again, pick and choose carefully, right? So there's DoorDash, there's Grubhub. Uber recently bought out Postmates, so Uber's obviously a choice. But I wanted to get back to when you were talking about software as a service and how they have subscription-based platforms, right? Just think about Netflix and Blockbuster. That's how, they sort of parted, right? Because Netflix, they used to actually deliver the movies to you, which was, like an early sort of a sort of Amazon for movies, I guess, right? But it was subscription based. That's why people loved it so much, right? Because for one weekend at Blockbuster, you'd be spending like $15 just to get like a movie, some popcorn, that type of thing. For Netflix, it was $8 a month, and you got unlimited movies. So a lot of these models that allow for optimizing the use out of them for a fixed payment system, they're a lot easier to understand because the financials are less complicated based on the demand, right? It's a subscription instead of individual customers coming in depending on what week it is, etc. And on top of that, you're locking in clientele, right? So yeah, again, I mean, Netflix's revenues, they were actually like unaffected. Even this last earnings, the revenue, they increased, even though the subscriptions were projected to decrease. So if you're considering looking at any SaaS companies, then consider first what their revenue stream looks like, and the more stable their model is, I guess, the more likely they are to weather the storm.
Right. So yeah, these software as a service companies not only have the benefit of making their business model easier and more beneficial to the customer, because in the end they have to pay less since they're only paying a subscription constant, X dollars a month instead of X dollars every time you want to purchase something. These the actual companies themselves have the added benefit of having that secured stream of income, so they don't have to lose a customer anytime soon. Or their subscriptions are going to last longer, and you're going to see more income in the long term. So these SaaS companies, like I mentioned, Zoom, Cloudflare, Nutanix, PagerDuty, Zuora, among others, are going to see a significantly positive outlook in the future as we continue to see more companies shift their business models online and capitalize on the added benefits that can be seen from on-demand services.
Exactly. And when we talk about innovation, right, in these SaaS companies, I'd say be careful because Blockbuster tried doing exactly what Netflix was going to do a couple of years later. They wanted to do a fiber optic streaming service that was on your, DVD players, smart DVD players. I forgot what exactly the year was, but it was obviously before 2000, around that time. So yeah, I mean, they were imagining a really big vision, and I think that if you see some of these SaaS companies, you may be misguided by that, because here's why: Blockbuster partnered with Enron to make a fiber optics service that delivered streaming right to your TV, and you can imagine why that went wrong because Enron was not capable of making software, and they're sort of this they're a scam, right? They're not a good company, so. The quality of these companies especially matters during a time where we're having, really big tests of sort of the virtue of these companies, how they're structured. I'd say look out for that, right? Because SaaS is very cool. It's a new technology. Everyone wants to get into it. It's sort of the shut up and take my money complex where you're just like, yeah, man, I want to buy, as much software stocks as I can because I see them going up. Just tread carefully.
Yeah. And in the topic of tech, we also have e-learning, which I think Raghav is going to go into a bit more. But I just wanted to say that e-learning is also a industry that has been very prosperous during this time as more people in countries, especially like China, where they're put into forced quarantine and had no other choice but to study from their homes. These kinds of people needed to rely on e-learning companies like China Education Group, among others, to get themselves educated. And as a result, they inevitably saw growth in their stock price.
Yeah, and a player for that same for the same industry in the United States would be Chegg, right? They did really good on earnings. But yeah.
Yeah.
So is that it for you, Mahesh? Does anyone else want to talk about SaaS software? No? Harish?
I was
right.
gonna as more
All right.
businesses,
Right,
like
okay.
small businesses, start moving towards this idea of like digital transformation, like shifting their idea
Hmm.
online and how to like you as you said, create subscription based service using these subscription based services. I think it's tech stocks and tech in general has a pretty bright future as long as until a vaccine doesn't come out, at least, because people are gonna stay home and gonna do everything online.
Yeah.
Okay, Raghav, since you said that, I'm gonna have to mention my point on that. You said, it might, at least until COVID ends, but because of COVID, we're also seeing a lot of companies just like permanently letting their employees stay at home, like Twitter. So we might see companies such as Zoom, which is frequently used for at-home working. These companies might not entirely go back to pre-coronavirus levels. They might flatten out a little bit in their growth, but I think they'll um, maintain most of their growth.
Yeah, yeah.
Yeah, and I feel like with the transition to reopening, there are going to be some people who actually liked it better before. Like, I mean, not in all cases, but just as it's more convenient for certain people to be working at home or for certain people to be learning online. And as more of these services grow during the pandemic, they might be able to maintain that growth after, as online learning will be hit, but some people will like the concept of online learning as after they've had a taste of it, if you know what I'm saying.
Yeah, but of course, it's different for every company.
Yeah.
Like I said, we have seen the CEO of Twitter say employees can work at home after coronavirus, but we've also seen Jamie Dimon, the CEO of Chase, say that in-office working is best for productivity. So it's going to be kind of a mixed reception after we end the quarantine.
Mm-hmm.
And I think.
Yeah, Harish, you're next.
Yep. Okay, I am next. Okay. Yeah, so of course, I'm going to talk about pharma, which is like the biggest industry we could say that's related to coronavirus directly. So pretty much after coronavirus hit, of course, we had pharma companies initially lose some of their value. But as soon as investors came over that initial panic, these pharma companies are rising at unnatural rates due to the possibility of the creation of a COVID vaccine, which of course would be a large potential profit for the company. But however, this is also leading to a lot of unnatural spikes and drops in the company's stock price when little news about vaccine research is released by the company, such as little hiccups or little improvements that can have a lot of effect on the company's stock price. We even saw the entire markets rise recently when Moderna released news about vaccine trials going correctly and creating some antibodies in the test subjects' bodies. And since a countrywide reopening would help all companies, we can see that this is the reasoning behind the entire market's rising with vaccine releases. Moving on from that, we have the fact that the health industry and a lot of hospitals, especially in the United States, have been criticized due to the shortage of supplies for healthcare workers and medical expense that is incurred due to the treatment for COVID. But I think that might be due to manufacturing halting. A lot of hospitals right now need supplies such as ventilators and masks, but the main companies that produce these things have shut down. And of course, we've seen companies such as GM, Tesla, fill in, creating ventilators, a lot of third parties creating masks. Does anyone else want to add anything onto that?
Like 3M is another manufacturing giant, and actually they had a pretty big order of PPE, and so their stock price was rising, and it just goes to show that the private sector is very important in times of crisis because they're pretty much the ones doing a lot of the things. A lot of these vaccine companies, a lot of these pharma companies are private sector. So, and they're the ones that are working to develop a coronavirus vaccine. Are they getting help from the government? Yeah, but largely they're private and not government owned.
Anyone else? Rutledge, Mahesh?
Yeah, I just say don't get too caught up in the vaccine stock mix because we're not necessarily sure, how much these vaccines are going to cost, or how much a therapeutic treatment is going to cost, like remdesivir from Gilead. It's sort of uncertain and it's choppy waters for sure. So if you are an amateur investor, make sure you know the stock well before just assuming vaccine and hit buy. So yeah, if it was a legitimately good company like Pfizer, for example, it's pretty undervalued, right? And they're also making a vaccine, and they give a good dividend, and they're a stock that everyone trusts. So yeah, like that's a good example. Like maybe you don't want to buy into Moderna or Novavax or Inovio, and any other random company that you haven't really heard of. But in terms of how investors should think about this, just tread water carefully again.
Yeah, and on the same note, I just have to say a lot of this comes down to FDA approval for a lot of these pharma companies. It's a very big high volatility event where if they get approved, their stock price just surges, and if they don't, it goes like near zero. So we've already seen that pharma companies are quite volatile. So it's risky waters if you want to start investing into these types of companies. It's best if you invest to the ones that are more mature and avoid the ones that are more hyped up or new. And just because a vaccine promise has been made doesn't mean it's going to go through phase 1, phase 2, phase 3, phase 4, etc., and then get approved by the FDA. So yeah, that's just what I had to say.
Yeah. This is less related to economics, but just something you should probably know. The United States has pre-ordered 300 million doses of COVID vaccine from AstraZeneca and Oxford University. And they expect to ready the vaccine for mass production around October of this year. Of course, 300 million population of the United States, approximately. However, we did talk about uncertainty. Maybe AstraZeneca and Oxford aren't the first ones to create the vaccine, and the United States might need to resource their vaccine purchase. So, other than pharma companies working on a potential vaccine, medical and other cleaning supply manufacturers have also seen drastic increases in stock price. So we would have initially expected the stock price of companies like 3M to increase based on that fact, but their stock price has in fact decreased since they're selling mostly to hospitals who would buy bulk and get amazing deals instead of their typical customers who would be the American consumers. And so when you look at a stock, I think it's also important to look at cash flow, but also who they're selling to and their customers. However, the companies that sell to individuals, like Clorox, for example, sells cleaning supplies, they've seen a stock price that's risen nearly 50% since early March. And most of that the gain has been during the past 2 months. Does anyone else want to say anything about like these companies, like pharma companies, medical companies that have drastically increased in price?
A lot of the increase in prices because the Fed is obviously just pumping money into these vaccine companies. So that's why they're rising at unnatural levels. Like Novavax is a good example. So yeah.
All right. And then talk about the capitalization of these companies. Of course, the market cap likely is going to go down for companies like Clorox once we reopen because the demand for these cleaning supplies will decrease. Same for companies like 3M, Novavax, and Inovio. After they release their vaccine, they immediately get cash, which might lead to their stock price jumping. But then once investors realize that cash flow isn't going to be coming in the future again and again, their stock price will likely return to pre-coronavirus levels. I'll be moving on to banking after this, so if anyone else wants to say anything about pharma, medical, cleaning supplies, go ahead and talk about that.
Yeah, I don't have much to say. I think you pretty much covered it.
All right. Then I'll start talking about banking now. So, of course, like I previously mentioned, banking has been negatively affected due to COVID. And although stock price has risen from the initial crash in March, bank stocks are still not at the levels that they were before March. And that's mostly due to, like what I said about consumer lending. Retail banks such as Wells Fargo and Bank of America have not reached pre-coronavirus levels. They're about, don't quote me on this, but I think they're about 30% less than their pre-coronavirus levels. And that's because these banks are mostly focused on lending money to the general population. And since a large number of Americans have become unemployed, lines of credit, mortgages, other loans haven't been paid back, and retail bank income has been drastically reduced. So this has led to a decrease in the stock value of retail banks, and which hasn't recovered despite rest of the market slightly recovering. But also we look at investment banks such as Goldman Sachs, Morgan Stanley, and they've seen their stock price increase much more than retail banks such as Wells Fargo and Bank of America, because they typically lend to richer people who have not lost their jobs due to COVID. They're mostly affected by how the market moves since they are an investment firm. And as we've seen the market increase, we've also seen the stock value of these companies increase to, I think, about 10% less than their pre-coronavirus levels. Does anyone else want to talk about this?
I think it's important for any investor to make a distinction between investment banking and commercial banking. So when you think about an investment bank, they're obviously, dealing with high net worth individuals who are concerned, pretty much about making what their next business move is going to be, right? They're always seeking out opportunity. So at any time there's an opportunity, these investment banks will do good. I mean, they might be better than pre-COVID because, there's more institutional investors that want to sort of figure out what they want to do with their money, buy out companies, have mergers happen. Like, Uber and Postmates, I mean, mergers have been going off. I mean, if you can tell, a lot of these have been very high profile. So yeah, I'd say watch investment banks, wealth management firms not necessarily do bad as expected. Just because they handle money and loans and all that type of stuff, it doesn't always mean that, they're going to be like super adversely affected by this.
Yeah. I just want to talk a little bit more about economic growth right now, talk about the macro trends. And I'm going to have to start that by talking about credit, which I did talk about before, but I will talk about it again. So credit is provided by these essential, provided by the banking as an essential part of growing the economy. Credit allows people to spend beyond their means, and they can pay that money back later. Of course, this is important for large purchases such as cars, houses, even other large purchases. You have business loans, things like that people might use. And of course, you have normal credit cards that let people buy larger items like, TVs, that kind of thing. And that's arguably why credit is the most important part of creating a growing economy and GDP, because it boosts people's buying power, lets them buy things that would normally be out of their reach. And of course, this credit would only be effective at improving the economy when the credit is repaid. But due to the amount of people, I think nearly 10 million more people are still unemployed compared to pre-coronavirus levels, which is, of course, why a lot of loans haven't been paid back. And that could be a reason for economic slowdown right now. Of course, not recession-type economic slowdown, but of course, economic slowdown nonetheless. And talking more about unemployment, it's people saying we are in a recession. But of course, that's false. The unemployment levels are currently so high not due to financial unrest like the housing crash in 2008, but because brick and mortar stores are closed down, they don't have revenue, they can't afford to keep employing these workers. As tech companies increase, though, I think these workers might have new jobs available at tech companies. Because tech companies grow, they'll need more employees to work for them. if anyone wants to add on to that, you are welcome to.
So what I wanted to say was, when we were talking about rates, we saw this similar thing happen when people who weren't able to pay back their rent negatively affected the balance sheets of rate companies. And in a similar way, people who aren't able to pay back their lines of credit negatively affect the banking industry. So it's this borrowing of credit that affects not only the banking industry, but other ones as well that rely on credit to fuel their industry that have been hit the most. And are going to be hit until unemployment rates go up and people are able to pay back their lines of credit.
And going off of what Mahesh said about the rights, if you think back at rights, we did tell you to be aware of what these rights are mainly focused in, such as commercial, such as subprime lending. That's also important for banks. Some banks are more conservative in who they lend to. They might only lend to wealthier consumers, and these banks might do better than banks that have been lending to lower income people that specialize in subprime lending, because they are not getting paid back right now. Rutvidge, Raghav, do you guys want to add anything on that?
No, I think
that's the bottom line.
I think you covered it perfectly.
Yeah. All right.
By the way, anyone who doesn't know what a REIT is, it's spelled REIT. It's called a real estate investment trust. So yeah.
Thanks for clarifying that. Yeah. Probably should have said that earlier.
That's my part, and I think we'll be going on to Raghav.
All right. So mine is probably going to be the shortest out of all of these, because obviously the impact on is obvious. I'll be covering tourism and hospitality and insurance and a small part of education. So obviously the industry which has suffered the most during this pandemic was leisure and hospitality. For example, airlines, hotels, restaurants, and different tourism destinations. So the industry actually saw a near 7.7 million jobs lost as coronavirus began to spread across the United States. That's around 47% of the jobs in that industry, and this is from the Bureau of Labor Statistics. So Congress passed a big relief package for all these companies, which included just $60 billion for airlines alone. Do you guys think it was that big? It should have been that big. I think these companies could have survived. Again, these huge corporations, but again, these underground airlines, maybe that's this money is what they needed. So do you think $60 billion is too much or too little?
Not at all.
I mean, I can't measure that, right? I mean, 60 billion, most people can't think of what that is. But that's about half of Jeff Bezos' net worth. So if you want that much, I guess.
But if you look at like the airlines industry too, that's also a number you really can't comprehend how big it is. 60 billion might really be necessary to keep these companies afloat. But then again, it might be a little too much, a little too little. But I think 60 billion, while of course that would seem really large to the average person, when you look at the airlines industry as a whole, I think 60 billion would be pretty reasonable.
Yeah. So again, the United States needs the airline industry to stay afloat, because the airline industry isn't gonna run out unless someone, maybe Elon Musk again, as he's proposing his new supersonic train. But again, the airline industry is an industry that's here to stay, and that's my opinion. So the reason this airline industry was losing so much, is because traveling by air was unsafe, because you're basically sharing the same airspace, and that could be a dangerous way to spread the virus. So let's talk about one airline stock that I'll use as an example, and why not to invest in lower market cap companies. So as this big dip mentality is called, right? Buy the dip. A lot of investors bought these airline stocks knowing that they would eventually go up. Some of that was a smart move, like buying big corporations, maybe like Delta, United, Southwest. But we'll use LATAM Airlines as an example. Again, LATAM Airlines was fairly big, the biggest airline in South America, but it dipped. It dipped a lot, like a lot of stocks. So a lot of airlines, especially the ones with the lower market caps, if you looked around the pre-coronavirus levels, they had uncertain futures anyway, and they had extremely low market caps. As of July 14th, 2020, LATAM Airlines had a market cap of $806 million. So that pretty much spells out trouble. So higher market caps means bigger corporations, more shares outstanding. So generally safer, a lot safer. I think you should shell out majority of your investments towards these higher market cap stocks and have around maybe 10%, 20% towards these lower, smaller, high risk shares or stocks. So LATAM Airlines was losing money tremendously fast, and on July 14th, they filed for bankruptcy. When a company files for bankruptcy, the stock gets delisted and you lose your money. Again, as for an amateur investor, you should not look for. Well, you should know what bankruptcy is and how to profit off of
Well,
it. But only experienced investors.
I just
Yeah,
wanted to say one thing, just to clarify. I mean, if a stock goes bankrupt, it's not in all cases that their stock will be
yeah,
delisted. Depends really on the type of the bankruptcy,
generally.
right? If it's more reform based, I think they keep the stock listed like Hertz, but or I don't know if you.
Yeah, but it's
I think yeah, right,
bankruptcy is a risky prospect for a amateur investor,
right,
and
right.
yeah, you should always consider market cap before investing in a company bound to go bankrupt. So I forgot to explain this term, but market cap is basically the price of your share
Of
times
course, yeah.
the current shares outstanding. So let's say you have a company, it has two shares outstanding, and the price of the share is $2. So that's two times two would equal $4. So $4 would be the market cap of that company. So generally, it's way more than that. It's in the hundreds of millions, billions, hundreds of billions of dollars. Yeah. So again, when coronavirus cases were actually decreasing, a lot of stocks in the tourism sector, for example, American Airlines and JW Marriott, all these big name corporations, saw a significant jump in June due to coronavirus cases decreasing, but the spike came again and they fell back down. Uh, and bringing to the point, this was the extent that many companies were going to because of the tremendous losses they were facing. Many companies actually sued their respective states' government to let them reopen as they were suffering immeasurable losses. So, for example, in my home state, actually, Kings Island is an amusement park 30 minutes north of Cincinnati. It sued the state to let them reopen because, again, they were suffering really badly. So, I'll move on to insurance. So, as many small businesses closed down to abide by lockdown rules, insurance companies began getting many millions of claims to cover these losses due to lost business. And as Americans started to get sick with COVID, medical insurance claims also went up substantially. Overall, insurance did lose a lot of money due to the number of claims coming in, and arguably the highest affected subcategory was financial insurance. So, what is financial insurance? Uh, well, in short, it's a type of insurance that covers losses for a business if their partner doesn't meet the contractual obligation in a given amount of time, which also happened during this pandemic, but it's not limited to that. Due to the high amount of businesses closing, many financial insurance companies were facing a tremendous increase in claims. For example, AFG, Geico, to cover the losses these businesses faced during the lockdown. I'll read an excerpt from Stephanie Cameron from bizfluent.com. Financial insurance can protect the policyholder from losses if their partner doesn't deliver the contractual obligations, but it can also protect against financial losses incurred through other kinds of situations. So, other kinds of situations um, is obviously the pandemic and maybe a recession. So, yeah, what do you guys think of the impact on insurance? Do you think it's a lasting impact, or do you think the insurance industry can rebound from this?
Well, okay. So insurance, I think, is also one of the other things that's like always going to be a necessity. And I think at the same time, like some insurance companies will benefit. Like, for example, auto insurance is mandatory, and I don't think they reduce payments because, I mean, what would be their incentive to do that, right? Like, sure, yes, the insurance claims, obviously they're less risky because less people are going out. Car accidents have decreased by like 80%, but at the same time, like, they're probably doing just fine, right? But health insurance on the other end may not be doing that great right now. So yeah, I mean, in terms of financial insurance, it's again all based around how well the market recovers and how bonds are doing, etc. And I think we can cover that more when we talk about capital markets basics later on. But I think insurance is a decent industry to invest in. And I haven't actually researched that much into how they've been really impacted. But at face value, I don't know how bad it could really be for them.
Yeah. So I mean, insurance companies are obviously going to get claims on claims, but right now it's just let's say time of more claims for especially financial and medical insurance. But again, some parts of the industry, insurance industry, like Ruthvij explained, like auto, home, they're doing pretty well right now. So I think you just have to look what insurance companies you want to invest in, and make your move. And I'll talk a little bit about education. So education obviously continued through the pandemic, but remotely online. Companies like Chegg, who is a major education industry player, saw an increase in the stock market due to education continuing online. The education sector saw 2.5 million jobs lost as a result of education moving online. So I'll just end with this statement. Overall, a lot of manual labor industries saw high unemployment rates because of COVID. For example, manufacturing, construction, tourism, all that.
Yeah, good points. So, do any of you want to make concluding statements? Raghav, do you want to finish your thoughts off, or do you just want to end it here? Because I think we're getting a little bit over the time.
Right.
I
mean, just to
No.
Okay, you can go ahead.
Yeah, you can go ahead. I didn't have it.
All right.
Okay.
So I mean, just to recap, we discussed a lot of the impact of COVID-19 on different industries and how valuation has been affecting the stock price of different companies, whether it's what companies to invest in, I guess, in each industry, and whether to decide if a stock is worth investing in, because valuation, I mean, these days it's been quite erratic and quite volatile. So yeah.
Thank you everyone for tuning in to our first ever episode of the Dogs of DeLaw Street. We hope to see you here again when we discuss our next topic. We will be releasing new episodes every Friday, so stay tuned. Follow our Instagram at DeLaw Street Podcast for updates and exclusive content. If you have any business comments or inquiries, please email them to delawstreetpodcast@gmail.com. We will be putting out polls so you can vote on what you want us to discuss next. Have a great rest of your day.